Welcome to Counters. In this lesson, we're going to be looking at accounting principles. We're going to explain what they are, and we're going to give an example for each of the principles that we'll be explaining. So what are accounting principles? Accounting principles are the required rules and guidelines that companies are required to follow when producing its financial information. So if everyone was to produce their information however they wanted to, then it would be very difficult for the users of financial information to make decisions because they would not know how they came about finalizing this financial information. But because accounting principles are the rules and guidelines that are followed, that means that the financial information that is produced by a company can be relied on to make decisions. Financial information is of interest to various stakeholders of an entity. This information is used to make decisions. As such, how the financial information is presented may influence the decisions that are made by the stakeholders. And that's why it's important for companies to follow accounting principles when they are preparing their financial data or financial information. So let's go through some accounting principles. Here is the first one, the principle of consistency or consistency principle. This principle focuses on the consistency with which methods and policies are applied in the preparation of financial information in each period. This is to ensure that information is comparable. If methods and policies change, this must be disclosed in the financial statements. So, as the word consistency is, we have to be consistent in our preparation of financial information. If we're going to look at a set of financial information for a specific company over a few periods, maybe 2 years, we should be confident that this information was prepared in a consistent manner from one period to another. And as it says here, if methods and policies change, this must be disclosed in the financial statement so that users are able to take that into account when they are analyzing the financial statements. What is an example of a principle of consistency? Well, here it is. The method and rate of depreciation on vehicles is expected to be the same as the previous years. So we know what depreciation is, the value of assets going down. So the method that is used and the rate that is used to depreciate vehicles, for instance, should be the same from one year to another. If you're depreciating your vehicles using the straight line method at 20% per annum, I would expect to see the value for depreciation at 20% per annum this period as it was in the previous period. If it changes for any reason, then this must be disclosed in the financial statements so that I can take that into account when analyzing the financial information. I hope it's made sense. The second one we're going to look at is the accrual principle. Regardless of cash movements, transactions must be recorded in the accounting records and shown in the financial statements in the financial period in which they occur. Accrual principle. If you know the accrual principle, we apply the accrual concept and you would know what is called prepaid income, prepaid expenses, income received in advance. Those accounts exist because of the accrual principle that is applied here. So what is the accrual principle? This is just ensuring that all the income that is earned in a specific period and the expenses that is incurred must be recorded and shown in the financial statements in the financial period in which they occur. If we have received money that we have not earned in this period, or we've paid out money for an expense we have not incurred in this period, we will not account for them as income or expenses, but we will disclose it as the accrual that it is, whether it's income received in advance, prepaid expenses, accrued income, or accrued expenses. We will account for them as such in the financial statements. So this is just to ensure that every transaction that happens in this period is accounted for rightly. And those accounts that I've just mentioned, you will find the links to those specific lessons in the description below, which would highlight this principle much better. So the accrual principle here saying that it does not matter whether cash has changed hands. What matters is that the transaction has happened, and this must be shown in the financial statements in the financial period in which they occur. An example here is the rent expense for the last month of the financial year is recorded even though it has not been paid yet. So if a company has incurred rent expense, it must record this expense even though the money may not have been paid yet. So that's what we are meaning by saying regardless of cash movements. As long as it has been incurred or an income has been earned, as long as that has happened, even though we have not received the money, it must be accounted for and it must be recorded. The third one we're going to look at here is the matching principle. Income earned and the related expenses incurred must be accounted for in the same accounting period and financial statements. So what are we saying here? The income earned and the related expenses that you have incurred in a specific period must be accounted for in the exact same period and financial statements. An example here is that the cost of sale is paid for in cash, but the sales is only received in the following period. The sales and the cost of sales are accounted for in the same accounting period. So what this example is saying here is that if you have paid for your cost of sales in cash and you've made the sales, but you have not received that money yet, it does not matter. You have to record the sales and its cost of sales in the same accounting period, because you would not have incurred the cost of sales if you did not make the sale. So the fact that you made the sale, you incurred the cost of sale, they must both be accounted for in the same accounting period. You cannot account for cost of sales alone in this period and then you say that in the next period I'll account for the sales. No, you have to make sure that you apply the matching principle where the income earned and the expenses incurred as a result of earning that income is accounted for in the exact same period. I hope that one made sense. Let's look at the fourth one, prudence principle. This principle centers on cautiously exercising judgment. When financial statements are prepared and uncertain results estimated, one must be conservative in the estimation of values. So this is exercising judgment cautiously in making decisions with whatever transaction that we are dealing with. An example here, the account of a debtor who is experiencing financial challenges is written off. So here we are exercising judgment to say this debtor is probably not going to pay us. We have to write it off and consider it a bad debt or a credit loss. That is the prudence principle. Another one we have here is the realization principle. Income must be recorded as soon as it has been earned and realized. Likewise, expenses must be recorded as soon as they have been incurred and realized. And it's very important what I have highlighted in red there. It has to be earned. If it's an income, it must be earned and it must be realized. What do we mean by realized here? Well, if someone has paid me money for products, I must have delivered those products to the customer, and that's realizing it. That's what we mean by that. And likewise, expenses must be recorded as soon as they have been incurred, if you have incurred an expense, and it must also be realized. If you paid for a service to someone, they must have delivered that service to me, hence incurring the expense. So those two must apply. That is when we applying the realization principle. Here's an example. An entry is made immediately in the books for an invoice received for goods purchased. So if we received an invoice for goods that we have purchased, and provided obviously we have received those goods, then that entry must be immediately made in the books. That means we are applying the realization principle. The sixth one we have here is the materiality principle. This principle states that information that is likely to influence a user's decision must be disclosed separately. Otherwise, they may be grouped together with amounts of a similar nature. So this is the materiality principle. You are looking at whatever information that you're dealing with and you're saying, is this likely to influence a user's decision when looking at these financial statements? If the answer is yes, then it must be disclosed separately. So let me give you an example. For a small company like Counters, for instance, if you are looking at an amount of 20,000 Rand, that is definitely material to Counters because it's a very small company. So that 20,000, let's say it's incurred as a result of an accident that happened and we had to pay out a third party. That 20,000 Rand is definitely material for a small company. So we'll have to account for that and record it separately or disclose it separately. But if you're looking at a multinational company, let's say Microsoft, for instance, 20,000 Rand or $1,500 would definitely not be material for them, so they do not have to record it separately, so they can group it up with other expenses such as general expenses, for instance. So I hope it's making sense. An amount is material depending on the size of an entity. And here's an example that we have. A significant fine incurred by an entity is disclosed separately in the financial statements. It cannot just be grouped with general expenses, for instance. So if a company has incurred a significant fine, let's say it's 40% of its revenue for that period, then it would have to be disclosed separately because of how big the amount is, and it cannot be grouped with others. So these are some of the accounting principles, and I hope we've spent some time explaining it well and you are able to get a grasp of how you apply accounting principles when preparing financial data or financial information. Here are some few other principles that you need to consider: economic or business entity principle, or business entity concept as others may know it as. This concept states that the transaction of an entity is kept separately and does not include the transactions of the entity's owners nor any other entity. So the transactions of the entity is kept separately from that of its owners or other entities. Another principle that is very common is the going concern principle. This is a principle that states that financial statements are prepared under the assumption that the entity will continue to exist into the foreseeable future, and thus all its data is kept using going concern values. So that is what the going concern principle is. I hope these principles have made sense. I hope we've explained it well, and if you have gained value from this lesson, please consider subscribing to our channel, liking this video, and share it to those you think it might help. Till next time, cheers.